Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to an abbreviated Veterans Day version of the Retail Focus Podcast with Trent and Leighton Kling. Coming up on today's episode, we'll talk about Party City and Party City disappointing. We'll talk about Black Friday sales being revealed at both Target and Walmart, and we'll wrap our show with yet another prediction that indicates that holiday sales could be incredibly robust this year. But we begin this episode with GNC, not before we tell you to remember to like us or rate us wherever you do access us. All that feedback certainly does help. If you've got an idea for a story, hit us up, retailpodcast@gmail.com. So as we mentioned, GNC reported earnings that more or less matched what everyone was expecting for them. Their third quarter showed dismal adjusted earnings with 2 cents per share. The real reason we're talking about this story here is that one new GNC initiative. They kept talking about it. Employees in the chain have been very excited about it, yet we're just not seeing the results from that initiative yet. Revenue came in nearly 5% lower year over year to $580 million. It was a soft July with depressed comps there. And taking action, management stepped up promotional efforts during the quarter. Just wasn't enough to save this quarter, either in the eyes of analysts or just in terms of those raw numbers.
GNC being a company that we've talked about for about 2.5, 3 years now on this podcast, and we try to cover them at least once a year, especially on their earnings reports. But you see, this is a company that has had a lot of ups and downs, and it's really been predicated upon the management strategy going forward. And you see that they've been restructuring a lot of how they've been operating, particularly in the U.S., but a lot of what management's talked about in the past, especially on this particular quarter, is how they're going to expand internationally through a number of partnerships, and one we'll get into in just a little bit. But you see that as far as restructuring here domestically, they're going to change the commission structure, or have already actually started changing the commission structure for their sales staff. So those employees that work at those brick and mortar locations here in the United States, and all early indicators point to it being sort of a success and turning around some sales momentum into the positive direction. And we see that they're going more from individual product incentives to bigger total basket incentives for those salespeople. So they want to try to increase everything that the customer buys, not just pointing them to one or two particular products that the salespeople have higher incentives with. This company is also looking at a number of ways, as they see it, to increase retention. And they think that commission, having higher commission in total, or at least in aggregate, will actually help people stay on board with the company and at least get the more motivated employees to stay with the company. And you can see that a number of other issues circulating really around in-store merchandising have helped to boost sales in the short term. We're talking about the last month of this latest quarter. And because of these actions to boost sales, specifically the promotional pricing, margins were negatively affected. Trent, CEO Ken Martindale, keeping with the positive sentiment, said that during the third quarter, their comparable store sales were softer than in the second quarter, but they demonstrated their ability to respond to market dynamics and drive sales improvements progressively as they moved throughout this quarter. So you can really see that they were really strong towards the end of the quarter, still not bringing in the top and bottom line numbers that a lot of people were wanting to see from a restructured GNC. That Harbin Pharmaceutical partnership that we covered many months ago seems to be firmly in place, and it seemed to be firmly in place then, but you get the vibe that they weren't really sure it was going to happen because no money was yet put down. Questioned this because this is a partnership we thought was already firmly in place, but they said that now that they got the first $100 million of the $300 million equity stake owed to GNC for this partnership deal, they feel like they are ready to go. And this equity partnership will see to it that GNC will leverage their brand with Harbin Pharmaceuticals' regulatory expertise in the region in order to sell products effectively in China. And as we know, the Chinese market is growing massively in the supplement industry. This partnership is massive and will most likely be a key driver for GNC revenue growth going forward. As such, their focus on the earnings call was more or less talking about the total company strategy moving forward rather than the domestic supplement market. So again, straying away from the domestic market, looking to expand internationally, especially in the Chinese market with this partnership. And even though it would have been nicer to get more details as to the domestic market insights in their most recent performance in the third quarter, you can see that some of the notes from the press release did highlight some of that restructuring. And going forward, Trent, it appears as though they're going to be closing 700 to 900 stores in North America. So we're talking about the United States and Canada over the next 3 years. And they're looking actually at not renegotiating leases or ending leases prematurely, but strictly looking at the markets that are already underperforming and just exiting when those leases are up. And this review has also identified other stores in which they are considering alternatives, such as seeking lower rent in the short term. But again, it's all about how those immediate locations are performing. And as of September 30th, to put this in perspective, so the end of the quarter, GNC had around 8,500 locations. So when I say looking to close around 700 to 900 stores in the next 3 years, it really is a drop in the bucket. Even though GNC has done a poor job of executing in the recent past, they still have a lot of retail locations in the United States, around 6,400 in fact, which actually includes around 2,200 locations from the Rite Aid franchise store within a store concept.
The international segment for GMC, this is one of the bright spots for the company, continued to grow. They noted an increase in sales of 6.1%, driven by 1.5% same-store sales for their franchise businesses. At the end of September, GNC launched the nature-inspired Earth Genius product line that spans multiple categories, and also they launched Tamiflex, which is an exclusive blend of botanicals that they say has been proven effective for joint health. Of course, anytime you hear the word proven when it comes to supplements, you always take that with a grain of salt. In terms of their brand mix, GNC's brand mix for domestic system-wide sales increased to 52% compared to 45% in the third quarter of 2017. What I'm saying here is that more products now are private label sold in GNC stores than they were in 2017. And actually, this compares favorably even in terms of quarter after quarter, because they were at 50% in the second quarter of 2018, 52% in this third quarter. And that's one of the reasons why they are so bullish on the GNC branded supplements that are most common already in the health and wellness marketplace, like something like a multivitamin, for example, in fish oil. So you're not talking about proprietary blends necessarily there. Ultimately, though, I think we were kind of disappointed, as were analysts, in, again, the lack of traction in the One New GNC strategy. Keep in mind, folks, this was launched in December 2016, and it was said in certain points in 2017 even that we were starting to see results from it. Well, we've started to see shrinking back here, and so all of these emphasis areas that GNC had going forward, like reformulation and different line extensions, and they wanted to be less trend-focused, all of these haven't really worked to drive traffic, at least domestically. And it turned out that their pricing structures, where they were rolling out a number of pricing structures back in 2016, they tried to simplify that into a single price for everyone and kind of a single price across the board. That hasn't really worked either. The simplification of My GNC Rewards hasn't really rewarded the company much at all, though they did mention an increase in loyalty membership of 10.7% in the current quarter compared to June 30th, 2018. There's now 16.2 million members in their loyalty program, including approximately 1 million members enrolled in the Pro Access, which is kind of the level up on their rewards programs. But again, you have more customers in your rewards program. That's great. You can get more data from them. Maybe they're more habitual consumers, but the bottom line is they're not coming in enough to make a dent in either top or bottom line revenue for GNC. Now, the main goals for the company remain the same. The more loyalty members they have, the higher the revenue, because loyalty members do spend more at GNC on average, especially the pro members. This is something we see across the world of retail. But one thing that we do see is a slowdown in the number of new members, and we have to remember that many of the current members were ones that had automatically transferred over from their old loyalty program. So again, really, really difficult to see where exactly they're going with this One New GNC, if it's going to continue. And one of the things that they stressed in their summer investor presentation that they made was the fact that they were using online marketing, a lot of paid search, a lot of SEO, a lot of social media marketing there, and trying to enhance their social media marketing presence. Well, overall, again, you don't want to say it's not working yet, but it isn't working yet. At least it's not showing up in the numbers, and we don't know how bad things might have gotten if they didn't reveal the one new GNC concept back in December of 2016. But again, things aren't good now, and as Leighton mentioned, you really have to question the leadership. And that's one of the reasons, Leighton, when you look at the market, shares actually fell very deep this Monday on Veterans Day.
Yeah, shares of GNC did fall, and they fell by a wide margin on Monday, 19% to a closing price of $3.41 per share. Shares have been all over the place during the last 52 weeks or so, extremely volatile, with shares in the high range of around $7 and lows around $2. This was a company that saw shares not that long ago, even though I say not that long ago, 5 years ago in 2013, trading over $60 a share. Now they only have a $286 million market cap, a company that went from sort of a household staple in the supplement market to now a company that is seeing their market share decline quarter after quarter. Moving on to two powerhouses in the retail industry, both Target and Walmart reveal their Black Friday plans above and beyond increased staffing plans that we've actually covered in earlier podcast episodes. But now both retailers provide a little bit more clarity as to some of their initiatives for the upcoming months and upcoming weeks in regards to Black Friday. And Black Friday this year is on Friday the 23rd. However, many retailers are having mini sales before that date, and most of the largest retailers, including both Target and Walmart, are starting online sales 1 to 2 days prior to Friday, especially all of those online sales that are happening in every niche of retail that you're seeing popping up. But last year at their peak, sales hit a combined $1 million per minute for e-commerce Black Friday traffic. And I say $1 million per minute. That was at their peak, but sales were robust before and after. Everyone talks about Cyber Monday. They were strong between Wednesday and Monday, so around a 5-day span that sales were strong. But first, we begin with Walmart and their plans. Walmart revealed their plans for interactive web-driven maps of their stores, allowing customers to carefully plan their most efficient routes through the store to get exactly the items that they want, or the items that have been promoted that they want at least. The sad irony of this is that this technology was actually Toys R Us's technology that was rolled out a few years ago, or a very similar technology that is, but they're no longer around to implement it, of course. And until 2017, Toys R Us had really been credited as a leader in the Black Friday preparation space, and their Black Friday sales were a big reason, in hindsight, the business was able to stay alive as long as it did because of their holiday sales in 2015 and in 2016. We did see some notable signs from Toys R Us in 2017, really making us believe that their double-digit comp declines were a big reason for their fall to bankruptcy. And Walmart's app is there to convert to sort of a mapping Black Friday version from 4 p.m. to 8 p.m. So you can go on Walmart. It's not a separate application on your smartphone, so you can utilize it to navigate your way throughout the store. We mentioned the surge in hiring earlier and the difficulty meeting the certain marks that companies have set forth, sort of some guidelines for how many people they want to hire during the next couple of months. In terms of seasonal hiring, it's unclear as to whether or not Walmart has done a good job attracting temporary help, but they are promising through various press releases and statements made to the public to have their stores fully staffed and equipped for the areas that will be most inundated with customers. Handheld scanners will also be in hand for employees, and they will also be debriefed as to where the different sales are going on and what items to look out for, what hot items that are probably going to be asked about most frequently with customers coming into the stores. On Friday, we got a full look into their deals, Trent. Online sales for Walmart are set to begin on Wednesday, the 21st at 10 p.m. Eastern Time. In-store sales will take place on 6 p.m. on Thanksgiving Day. And the big takeaway here is that prior to the 6 p.m. opening, Walmart is doing something a little bit special, a little bit newer, at least for them. Shoppers will be able to get cookies, hot cocoa, and coffee 2 hours prior, because basically they're getting rewarded for waiting. This event's going to be dubbed Light Up Black Friday, so they really want to make this an event type of theme. And I think this is really going to do well for the people that have spared time, have really been devoted customers to Walmart in the past. You have to wonder how cold it's going to be for some of the customers waiting outside. I'm sure they will probably be opening the doors for this type of event, but regardless, a lot of people probably lining up for these particular deals, Trent.
And this is an interesting strategy for Walmart because it's much more of a strategy of a smaller retailer there, giving away cookies and coffee, that type of thing. Much more what you would see on that Small Business Saturday than you would see on Black Friday. But per always for Walmart, electronic items really going to be the focal point again this year. TVs, laptops, cameras, game systems, and also some household items like vacuums and small kitchen appliances like pressure cookers, all included in Walmart's sales this year. The 65-inch TVs as low as $398, 40-inch TVs for $99, quite the price on those. But between the actual sales items and the service, Walmart's CMO, the Chief Merchandising Officer, said that they are pulling out all the stops, and I quote that, and that teams recognize Black Friday as the biggest day for the retailer, so they feel like all hands on deck once again this year, even though they're trying some new strategies, trying those interactive maps. Now let's move to Target. In addition to the immense amount of hiring Target has been doing, their reveal of Black Friday plans took place well in advance of the retail event this year. In fact, some of their plans were rolled out as early as November 1st, a good 21 days in advance of Thanksgiving. This is much earlier than in years past. In 2016 and 2017, both Black Friday plans were released to the public no earlier than November 7th, and some even trickled out a week or so after that. Granted, Thanksgiving is a touch earlier this year, but not by that much. I think Target really leading out in terms of what they're doing this year versus last year. And as before, this surprises no one, Target is opening the evening of Thanksgiving. The difference is when they're opening on Thanksgiving. They're opening at 5 p.m. this year, whereas last year and in 2016, Target opened at 6 p.m. on Thanksgiving and then 6 a.m. on Black Friday after closing Thanksgiving night. Now, this year's stores will close at 1 a.m. on Black Friday, only to reopen at 7 a.m. on Black Friday. So we're seeing that they're moving their opening time an hour later. Couple of different mindsets to this. One is that if you're going to be open Thanksgiving, may not be a reason to be open that early on Black Friday. The second is maybe it gives your customers a chance to stagger their Black Friday sales. They can hit up other retailers that do open at 5 or 6 a.m. and then make sure they get to Target for that 7 a.m. opening. So kind of a nod to the increased acknowledgement of Black Friday's push into Thanksgiving, noting that so many sales will probably take place Thanksgiving evening. Target apparently sees no reason to compete with others in the early Friday morning hours. They're trying to differentiate by moving a little bit later to the day. And we wonder kind of how many more retailers will make this type of move in the future. It makes sense, after all, to open a bit later on Friday if you're open already Thanksgiving evening. Number of different reasons here, but one of the main ones for Target, at least internally, is it gives staff a chance to reset the store. You get to roll pallets out of the merchandise without the risk of running over the throngs of customers. Any retail employee that has worked at a big box store during Black Friday knows it can be a hassle to get additional merchandise out because you've got to move it through people, especially when you're dealing with pallets or pallet jacks or four-ways, any of those things. So in order to move that stuff out, really does help to close the store for a little bit, get everything reset. So as with last year, one of the things that Target is doing similarly is they're continuing with their Weekend Deals series, which began this weekend and will run each weekend through December 15th. Cartwheel, once again, plays heavily into this initiative. This trend began in earnest back in 2016 after Cartwheel's initial rollout in 2013. That isn't to say that Target didn't have deals that were centered around Cartwheel, but Cartwheel is a huge part of this program and has been for the last 3 years. Target claims 30 million customers use Cartwheel. However, we don't have any information on active users, so we don't know how many people have used it just once or twice in the last year, maybe downloaded the app and haven't used it on a regular basis. But aside from all the developments in the area of schedules and the individual sales themselves, like what we talked about with Walmart, some of those TV deals, the most notable push from Target this year is their mobile checkout technology. I'll be anxious to see how this works for them and whether it's able to work smoothly, because this is going to be the greatest test nationwide for this technology as well. One of the things that Leighton mentioned earlier is that Toys R Us technology, that now Walmart isn't using that exact technology, but Walmart doing a similar thing. Well, this mobile checkout technology, this is something that Kmart had in place beginning in the early 2000s. And Kmart would actually use it for major events such as clearance sales and Black Friday or Thanksgiving sales. But the technology eventually took a back seat in Kmart's and other retailers, but now is being rolled out in a more refined version by most of the major retailers. And the differentiation here, Leighton, between this technology and some of the other mobile checkout technology, in the past we've seen mobile checkout stations. This is all a handheld device, very similar to things we've seen tested in the retail space in the past, just not rolled out on a complete nationwide basis.
Yeah, and when we see this type of technology, it usually is during the busier times of the year. So this is definitely one of the busiest times of the year, if not the busiest for Target. Target's mobile checkouts consist basically of staff with handheld devices scanning and accepting payments for purchases anywhere in the store. So again, like Trent mentioned, not just at the front of the store. The idea here is that it will decrease front-end congestion and allow people coming in to just pick up an item or two and get the convenience of not having to wait in line. And this is something that I personally witnessed years ago at a Target where early in the morning on a Black Friday, the lines were backed out to the middle of the store and people were getting not too happy with the fact that they already waited outside before the store opened and then had to wait another 4 to 5 hours just to check out with that particular item. So if you factor in the total amount of time, you're talking about a 10, 11, 12 hour expenditure, really, and time is money. If you're one that really factors in time and values your time, you have to look at maybe a $200 or $300 discount not really being that worth it if you have to wait that long. But not only front end congestion will be alleviated with this measure, but also congestion in the electronics section, which is always a popular part of the store on Black Friday for Target. But the company says a number of their mobile checkout devices will be deployed near the back of the store. Also, as with years past, associates will be able to place Target.com orders on behalf of customers and have products shipped to their door, which is designed to assist particularly with locally sold out items there. And finally, for what it's worth, Red Card holders will have the opportunity to shop early online for a select few Black Friday deals beginning Wednesday, November 21st. We're not sure how much traffic this will drive to the website, but by having it web only, they at least avoid the confusion it might cause to have different price points on in-store deals. And I'm a Red Card holder, Trent, and I'm probably actually looking to buy a TV that they have on sale, but overall, you have to look and compare these type of initiatives with the other major retailers, and I have to say, they're some of the best out there. And during their ads, or the ads at least that we can see so far with these Black Friday events, the ads are extremely transparent because they tell you on each individual section when that item is going on sale and if it's going to be just an in-store item or an online item. That aspect is a little confusing when you compare them to other retailers, especially in the electronic space with Best Buy. Those type of merchants aren't doing as good of a job really displaying their deals and their structure of the sales.
Well, we continue this retail focus with Party City, a retailer we had been bullish on in the past. They surprise analysts by coming up short on earnings. The headline here was their substantial miss, coming in with adjusted earnings per share of 8 cents compared to analysts' consensus estimates of 17 cents per share. Last year, for reference, the company made 13 cents per share. This was the first time in the last 3 quarters they missed estimates, and very few people thought that there would be such a wide 52% miss in this third quarter. On a GAAP basis, even more alarming, they reported a net loss of $2.4 million, or 3 cents per share, after income of $10.1 million, or 8 cents per share. Revenue, including Party City's retail and wholesale revenue, hit $553 million, a $39 million miss. So they missed on both top line and bottom line. Like with earnings per share, Party City has been solidly beating top line projections over the last year. So this is why this caught everyone by surprise, particularly during a chunk of the quarter that featured Halloween prominently in those Halloween City stores that we talked about on a previous episode. What is most worrisome, at least for us, is that year-over-year revenue declined by $7 million. Same-store sales fell 1%. And it's one thing to say, hey, we're not making the bottom line like we thought we would because of tariffs, because of other things, even though we've got a massive amount of vertical integration, still sourcing a lot of materials from overseas, but they're just not selling the goods like they have been. And it's not like GNC, who we talked about earlier, where they've been in a steady decline. This really comes out of nowhere for Party City, and despite what are objectively strong quarters for the first half of their fiscal year, Party City shares have now fallen over 28% year to date. After these results, shares dropped another 11% last Thursday. So Leighton, the question remains, why was the top line and bottom line both soft for this latest period for Party City?
You mentioned Halloween sales and how important they are for Party City, especially during this particular quarter. And this is a quarter that we always look to for Party City because they try to really take advantage of those one-time sales. But Halloween sales were actually said to be soft, down around 90 basis points. And there was e-commerce competition. So we're talking about the company as a whole and why top line was soft there. Well, e-commerce really is taking a bigger chunk than even personally you and I thought they would really take out of in terms of Party City's overall business, because Party City, we all know that they don't really have totally high-priced items. They don't have very quality items that you would really see in a more niche store. So their price point is fairly low, but this really does have an opportunity then for competitors like Amazon to come into the mix, because oftentimes you are buying in bulk. So shipping usually gets offset because people are buying multiple items at any given time. But sales at Halloween City stores, the pop-up shop that Party City had during this latest Halloween season, with Spirit Halloween being the main competitor, those Halloween City stores did okay, but failed to make any really substantial strides versus the 2017 numbers. Party City this year opened around 50 pop-up stores that doubled as Toy City pop-up locations, according to an article on Vox. A total of 250 Halloween City pop-up locations opened up throughout the United States, but previous statements from management expressed just how important September and October are for the company, saying that Halloween is basically their Black Friday or New Year's equivalent. And we talk about their vertical integration a lot with Party City, or at least we have in the past, talking about their manufacturing efforts down south, and Halloween supplies are no exception here. Party City now manufactures a lot of their own costumes, giving them leverage both in terms of margins, as you would expect, and in terms of identifying trends and trying to capitalize on trends in particular areas that aren't seen by some major competitors. So wherever their competitors are lagging, the idea here is that they can get to market quicker and do so a little bit more effectively while still growing gross margins. Very fascinating, and a business concept that we think is right for their type of business, their retail niche. Being in the party arena, you really have to look at the ongoing trends and try to identify what's hot and what's not. And despite their own manufacturing with many of their own products, not just those Halloween products, a lot of what they source is still from third parties, Trent, and it still is coming from China, or a lot of it is still coming from China. And tariffs have been having a real effect on cost of goods sold for this company and others. As we mentioned on the podcast here recently, 2 episodes ago, we talked about Tile Shop and how they have really been feeling the pressure, and most recently, Lumber Liquidators citing worry about those 25% tariff concerns in January. But as for Party City, they cited major disruption. I quote, major disruption along their supply chain, and said they're doing everything in their power to try to negate and offset those particular costs. But their certain leanness in inventory is really credited towards this supply chain issue. So really the idea here is that they're trying to hedge costs by not buying as much inventory to house in their stores, which actually makes sense, because if tariffs go away in the long term, then you pretty much win out. However, in the short term, because of the demand for some of these products, they've actually hedged incorrectly, basically saying that they've ran out of some of these items, and so they've been hurt by their ability to become lean. And because they've sold more of certain items and sold out, they don't have these items in the store, on the store shelves anymore. That really made them miss out on that top line revenue. So again, this is in certain cases. They did mention that the products that they manufacture themselves have been fully stocked, and that by selling them, at least in domestic stores, this had allowed them to offset some of the shrinking gross margins. They are getting some efficiencies born out of their processes. They said they actually grew gross margins from the products that they manufacture by around 60 basis points. So not too bad, but again, it doesn't counteract all of the negativity surrounding their business. Something new to us to hear about, again, talking about more of their products here and how they manufacture and have been dealing with certain issues. Something we've never heard of, or at least talked about on the podcast, is the relative helium shortage that the company is experiencing. In the past, on the Food Focus podcast, the now defunct Food Focus, we talked about shortages in avocados and how it affected the supply chain of Chipotle. But helium is not really a topic we talk often about. And Trent, this shortage affected their ability to push out more metallic and latex balloons, which, believe it or not, affects a lot of different areas of their business because people buy balloons for nearly every occasion, it turns out.
Yeah, helium on this episode. We talked about floor wax a couple of episodes ago. Two inputs that we thought we would definitely never cover on the Retail Focus podcast, but here we are. On the call, CEO James Harrison noted how general industry softness, and I think by industry he means perhaps the party goods industry softness, negatively affected their wholesale business, because industry softness, certainly not a phrase we've heard much of in any area of retail this year, unless you're talking about Sears, which Sears Holdings will blame everything other than their own leadership for their troubles. But this is really the first we're hearing about industry softness in a particular area, and we think it comes directly from, in all likelihood, party goods rather than the whole of retail, because we know how strong retail sales have been recently. The call did have a mostly negative tone, as you would guess, as it related to their most recent performance, but Harrison was more optimistic when highlighting some of the sales incentives and merchandising improvement plans they've put forth. Sales staff will, they hope, be more focused on helping with party planning, where you can have free help when providing a type of event and theme, basically trying to garner every aspect of an event and business around that event that they can, almost similar to what you would see out of a home improvement retailer, trying to provide that beginning to end customer service to build that overall experience instead of building a kitchen or a closet. Here, you're building a party. They've improved aspects of their website, and certainly this is something that we've seen. We argued that their website was a little bit subpar over the last couple of years when we're talking about their increased e-commerce focus. And if you just hit the main landing page, it looks a lot better, a lot less cluttered now. Buy online, pick up in store option continued to gain traction this last quarter. That was one of the positives for Party City. Penetration of e-commerce sales now reaching 16%, up from 10% in this year's first quarter. And they said they will continue to invest in this and other broad initiatives like SEO, or search engine optimization, which we talked about with GNC, which has admittedly also been a struggle for them in the past, losing out to other e-commerce retailers. Overall, they're happy with the performance and appearance of their Amazon storefront. A lot of positives from this call coming from e-commerce. This is an avenue that we were bullish on a few quarters ago, which is why it's disappointing to see a falling top-line number, because they're rolling out all of these initiatives with buy online, pick up in store, their Amazon storefront, even though most of the softness was related to their conventional brick-and-mortar footprint. The digital sale focus wasn't enough to balance out their total top line.
At quarter's end, they had roughly 959 stores in total, 862 of which were corporate stores, as they opened 3 net new stores for the quarter and acquired 65 franchise and independent stores over the last 12 months. For 2018, Party City expects revenue around $2.43 billion to $2.46 billion, down from previous guidance. So they actually revised guidance in the downward direction. That previous guidance was around $2.44 to $2.49 billion. Shares of Party City, ticker PRTY, are down for the year, like we said. All of this year's losses, however, are really attributable to the time period between this last September or mid-September to now. Shares are down around $10.68 per share, with a market cap of around $1 billion and a price-to-earnings ratio of just 5.8. It's around 5.8 because of that forward guidance. It's not looking too good for them in terms of year-end profit and year-end revenue, but shares are more or less at a 2.5-year low. Not good if you're a longtime shareholder. And honestly, Trent, not good for management, because this really is going against the grain in terms of what they were saying with their strategy over the last year or two. Being more vertically integrated, you would think that they'd be a little bit more profitable. To say that gross margins increased for their private label goods only by 60 basis points, and to say that overall manufacturing is not that great, and overall the tariff issues as well coming into the fold, and they have yet to experience that 25% tariff on their Chinese goods selection. So a lot of headwinds coming for Party City. This is only the beginning, and really only the beginning too, in my opinion, because if you look at their last 4 quarters, they've actually not been that bad, but this is by far the worst during a period in which it should be their best quarter because of those Halloween sales and the momentum heading into the holiday season. And as we talk about the holiday season, that is exactly what our last story has to do with, as we look at one projection that sets a massive expectation for retailers over the next 7 weeks. The most recent report covered by the Retail Dive comes back on the NRF numbers that we came out with and talked about in October, expecting sales to increase by approximately 4.3 to 4.8%. Generally, for reference, the NRF expects full-year retail sales to be and around 4.5% higher in 2018 than in 2017. This latest report comes by way of B. Riley FBR, and this is a company that is a leading full-service investment bank. They provide comprehensive research for corporate finance, research, sales, and other services to a number of growing businesses and mature businesses, by the way, that are looking to be taken private. They pride themselves on unlocking data in sectors or industries that they feel is misunderstood by larger institutions on Wall Street. So now that we've said that, we look at the analysts inside the company. These analysts were led by Susan Anderson for this latest report. They mentioned that same-store sales will hit 2.2% this holiday shopping season. We're talking about brick and mortar. This would represent a sequential rise over the last 3 years. So between 2016, 2017, and 2018, if this bears out, this positive increase is only growing. This momentum is positive thanks to a number of initiatives, particularly omni-channel. In this research, many of the long-standing brands could benefit. They mentioned Hasbro being one, The Gap being another, and a company we actually don't talk about often except for their very, very poor earnings reports, Chico's. So we're talking about winners in nearly every category, and some long-standing companies that have actually had some problems since the Great Recession, Trent. And this study finds that lower rents, something we've actually not seen in the most recent earnings reports from the nation's largest retail-focused REITs that we've covered on the podcast. They said that those lower rents are actually going to help the operating cost structure of retailers, and in particular, drive up gross margins and profits for retailers during the holiday season. So what actually makes a little bit more sense is the consolidation aspect that they touch on. During the study, they found that those retailers that are going to be directly affected by consolidation in certain areas of the economy are going to be the ones that stand to make the most money. And so we talk about consolidation, we have to talk about those recent bankruptcies, one with Bon-Ton that is obviously exiting the mall space or has exited the mall space, and another being Sears, which they're exiting around 170 to 180 stores in the coming months. But other retailers like Party City, for example, could see short-term gains from the exit of Toys R Us as well, something that this particular article doesn't mention, but you have to scratch your head and think about what directly is going to be affected from Sears closing their doors. To be honest with you, Trent, I don't think that much, because you really have to relate Sears with the other mall retailers. Those retailers are experiencing troubles as well. You think of Dillard's, you think of JCPenney, all retailers that are hoping for a positive holiday season, but not necessarily going to get one.
And I think it harkens back to what we were talking about with Toys R Us during the Toys R Us bankruptcy. In the middle part of the year, it seemed like everyone was coming out with these toy sections, and we said, ultimately there can't be that much market share left to garner, because if you're Toys R Us, yeah, you took up a big piece of the market share in the US, but they had been struggling. And you look at Sears, that's a business that's been struggling even more and even longer than Toys R Us was. So don't really see too many positives there. And I think the lower rent aspect of things certainly made us raise our eyebrows, because we cover REITs a lot on this podcast, and lower rents, not something any of those REITs have been talking about, as many of their revenues have started to increase because of rent hikes, because there are a lot of A and B shopping centers. They're able to increase rents because they have a lot of takers and a lot of waiting parties. Also, Chico's, not sure about that. Still somewhat bearish on that retailer personally, but I'll be anxious to see what impact the holiday season will have on Chico's. Overall, though, I want to keep it positive here because the study is very positive, and the study highlights ideals that we were already privy to. Those retailers with the cleanest stores and the best functional omni-channel experience are going to drive the most traffic and therefore the most sales, something Target and Walmart already know. That's why they're doing a great job in terms of preparation for a variety of customers, as we noted earlier in the podcast. But the increase in discretionary income is likely going to be the biggest macroeconomic factor. This is something that both studies like this and also folks like Jack Kleinhans at the NRF have been talking about for a while now. A lot of discretionary income floating around there. And for retailers to succeed in the near term for the holidays and take advantage of that discretionary income growth, they have to already be catering to the demographic that's seeing the biggest rise. Upper middle class and upper class individuals have seen the largest absolute income gains, which in theory should favor niche specialty retailers this year. Target, it could be easily argued, tailored more towards a middle to upper middle class dynamic than Walmart. Walmart, however, does have the inherent benefit of having Sam's Club under its wing, which of course deals with individuals with a bit more discretionary income. And I think the key here is when you're looking at this, it's not just the income growth for the middle and upper class. Oftentimes it's the income growth for the lower and lower middle classes that make such a huge difference when it comes to retailers like Walmart. If you have even $200 or $300 more to spend during the holiday season, well, that's going to make more of an impact, and you're going to be more judicious in terms of how you spend it, which is why it's important for you to be on your game if you're a retailer that caters towards all individuals, not just the middle to upper class individuals. Overall, holiday discretionary income is expected to rise 5.8% this year, which is actually more than is expected to be spent, according to the earlier NRF sales figures that average out an increase of 4.3 to 4.8% in holiday spending this year. This could, in theory, mean that sales could be even higher than the top end of this range if people save less than they already are, which is entirely possible given consumer sentiment and just the overall desire to not think about one's long-term financial well-being when you get around the holidays. A lot of retailers kind of predicate themselves on the lack of saving tendencies among consumers. But one other thing I should mention there too is that we've seen over the past 2, 3, 4 weeks a little bit of market volatility that could potentially erode some of that consumer confidence, might make people ferret away a little bit more money for the coming months. We will wait to see, but I think that market volatility certainly not a positive thing when it comes to these retail forecasts. And overall, generally speaking, the arbiters of this study, B. Riley FBR Incorporated, they seem to indicate that the environment is markedly better year over year. Last year was good in comparison to 2016, but they do feel like the stronger players in the retail marketplace will continue to differentiate themselves with the weaker ones and widen the gap even further.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
Well, we've reached the final segment of the Retail Focus podcast, a segment we call Looking Ahead, where each Leighton and I take a look at one story we're keeping an eye on for the next week, month, or year. We may even cover it later this week on the next Retail Focus podcast, and we begin with Leighton.
Well, we were looking at future retail topics to talk about on our Looking Ahead stories, and around 9 minutes ago, it was announced that Amazon is in fact going to pick New York City and Northern Virginia for their additional headquarters. It may be made official via press release via Amazon on Tuesday of this week. And this was actually already rumored to be taking place. A couple sources close to the matter last week said that this was probably going to be the case in terms of having New York City and Northern Virginia as the second and third headquarters, we should now say, for Amazon. And Amazon's obviously been looking for a new home for their second headquarters. And between these major sites, Trent, supposed to be around 50,000 additional employees. That was what it was originally slated to be in September of 2017. Now it's rumored to actually be a little bit more than 50,000 employees because of the split between these two headquarters, and another statement by an insider saying that they are looking at additional major sites that they've already been looking at for this other headquarter location. So other major sites could mean other major metropolitan cities. Cities in Ohio, for instance. San Diego was another city that was trying to really put forth their best effort to attract Amazon. But what should be said about this is that a lot of people were worried about the infrastructure, meaning that they were worried about the cars on the roads, the traffic during rush hour, because New York City already has horrible traffic, and so does Washington, D.C., another area that was rumored to take the Amazon headquarter location. So you have to look at all the additional employees and what it means for these municipalities. Well, for the city of New York, they were actually looking at making a little bit more of an investment in terms of their infrastructure, around $180 million. And they had brought this to Amazon's table saying, listen, we're actually going to boost our infrastructure in preparation for a potential Amazon headquarters. And now they have to go through with that. It's actually going to take some time, just like building the headquarters. Obviously, it can't just be done overnight, but that is what I'm looking ahead to really see how this happens, how long it takes for them to split this headquarter location. That is going to be a major thing I'm looking forward to, because that was sort of an issue, or not even sort of, it was a major issue with the city of Seattle, because a lot of people were complaining about the congestion on the roads already between Microsoft and all the other companies that do business up there, which include Boeing and a number of other organizations in the online space. So I'm very curious to see how this plays out and to see what the other major sites are going to be in the future for Amazon.
What I'm looking ahead to is actually the holiday that's in this month, in November. Not so much spending for the holidays in December, but I'm always very interested in terms of food trends and how that will impact shopping. You know, food trends more and more seem to gather steam on websites like Pinterest, for example, and this is something that we've seen over the past few years. So some of this year's popular food trends on Pinterest include things like Brussels sprouts, for example, which are kind of making a comeback, and they've been really big in grocery stores recently, but also we're seeing a lot of momentum towards things like Dutch apple pie, and a lot of healthy recipes, a lot of recipes including sweet potatoes, things including cranberries, of course, but a lot including almond flour, almond milk, that type of thing. So you're seeing a big push towards vegan, a big push towards dairy-free. And so my looking ahead story really is about how this will impact grocery stores this coming Thanksgiving. I think it's an adage in grocery stores. A lot of times you're going to be, stocking up plenty of turkey, stocking up plenty of potatoes. But what are some of those ancillary items that are going to see the boost in retail stores this year that maybe retailers weren't expecting? What are those items that we're going to see a run on the Wednesday before Thanksgiving in stores? What's going to run out, and what are retailers going to learn as they get ready then for another cooking holiday towards the end of December? Well, that'll do it for us here on the Retail Focus Podcast. For Leighton, I'm Trent. We'll be back later this week with another edition of the Retail Focus Podcast. More retail news, information, and insights.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.